People hear the term DSCR loan and it sounds way more complicated than it actually is. Debt service coverage ratio, that's really all it stands for. And once you understand what lenders are actually looking at, it becomes pretty straightforward. At its core, a DSCR loan is about the property, not you. And that's honestly the biggest mental shift for most people. Traditional loans are personal income driven, right? W-2s, tax returns, pay stubs, debt to income ratios. DSCR kind of flips that on its head. The lender is really asking one main question: does this property support itself? They look at the expected rent, or sometimes the actual rent if it's already leased, and they compare that to the full monthly payment. Principal, interest, taxes, insurance, and any HOA. If the rent covers the payment or comes close enough based on the program, you're in the box. And that's why investors like these loans so much. You're qualifying based on cash flow, not personal income. That means you can scale without your tax returns becoming a bottleneck. You don't have to explain write-offs. You don't have to show increasing income every single year. The property kind of stands on its own. Now, that doesn't mean personal finances don't matter at all. Credit still matters, reserves still matter, down payment still matters. This isn't easy money. It's just a different underwriting philosophy. One thing I always make clear is that DSCR doesn't mean the lender ignores risk. They're just shifting where the risk is measured. Instead of focusing on you covering the payment with your salary, they're focused on the asset covering itself. And that's why you'll usually see stronger down payment requirements, higher reserve requirements, and slightly higher rates compared to conventional loans. The DSC 1.0 means the rent equals the payment. 1.1 means the rent exceeds the payment by 10%. Some programs allow lower ratios, some require higher. It really depends on the lender, the property type, and the overall strength of the file. And here's something a lot of people miss. DSCR loans are not all the same. Some lenders use market rent, some use actual lease rent, some use short-term rental projections, some don't touch short-term rentals at all. So you'll hear completely different answers depending on who someone talks to. And that's usually where confusion starts. Another misconception is that DSCR loans are only for big investors with huge portfolios. That's not true at all. I see first-time investors use DSCR all the time, especially when they're buying their first rental and they don't want their personal income to be the limiting factor. DSCR works for single-family rentals, 2 to 4 units, condos, townhomes, even some mixed-use properties depending on the lender. Again, it's all about structure. Refinances are really common with DSCR too. A lot of investors buy with cash or hard money, stabilize the property, then refinance into a DSCR loan once the rent is in place. And that's where these programs really shine. Turning equity into capital, the trade-offs, because that part matters. Rates are usually higher than conventional. Not crazy, but higher. And that's the price of flexibility. If the property cash flows and the numbers make sense, most investors are totally fine with that. Reserves are another big one. You might need 6 months, sometimes 12 months of reserves, depending on how many properties you own and the lender's guidelines. That's not a penalty. It's protection for you and for the lender. One thing I really stress with DSCR is planning up front. Understanding how the lender calculates rent, what expenses they include, how conservative they are, and how that lines up with your strategy. That's the difference between a smooth deal and a frustrating one. DSCR loans aren't about gaming the system. They're about aligning financing with how real estate investing actually works. Properties should pay for themselves, and when they do, everything else gets easier. Once people understand that, DSCR stops feeling mysterious and starts feeling logical.